Welcome back to the Deep Dive. Today, we're strapping in for a high-velocity look at one of the market's most, well, let's just say talked about stocks, Tesla Inc., ticker TSLA. We've pulled apart a stack of recent analyst reports, really focusing on the Q3 2025 earnings and, the massive future outlook that seems to be driving its valuation. Our mission today, basically, to be your expert guide through this stuff, help you understand this immense gap between the current financial results and, well, tomorrow's sci-fi projections. We want to figure out what the market is actually buying here.
Okay, but before we dive in, just that critical reminder, we're relaying the facts and the analysis from these source documents. It's purely for informational, educational purposes. This is absolutely not financial advice. You really must perform your own research, your own due diligence before making any investment decisions, seriously.
Understood. Completely clear. So let's jump right into the core tension then. Right now, TSLA trades at what, $438.97?
Yeah.
Yet the consensus among these analyst reports points towards a fair value closer to $305.70.
Right.
That difference, it's a staggering $133 premium per share. That's what we need to unpack. What colossal promise is the market paying for today?
Yeah, that gap, that $133 premium, it really defines the whole story for Tesla on the public market right now. It's fundamentally a bet on potential, not really present-day performance.
Okay, segment one then. Let's look at the present reality. The Q3 2025 earnings, it was kind of a mixed bag, wasn't it?
It really was.
Let's start with the operational reality from that third quarter. The good news is they are still growing, right? Deliveries hit a record 497,099 vehicles.
Almost 500,000.
And total revenues were $28.1 billion. That actually beat the consensus estimates.
It did. Top line looked pretty good.
And they generated record free cash flow, too, around $4 billion in the quarter. So deliveries are strong. Demand doesn't seem to be the core issue right now.
Exactly. The volume is there. And that's precisely why the profitability data that follows is so important. Because what's fascinating here, despite that top-line growth, despite the impressive cash hoard, the core profitability showed a really sharp contraction. We saw GAAP operating income just plummet, down 40% year over year. It settled at $1.6 billion.
30%. Wow.
Yeah. And crucially, the operating margin fell significantly, down to just 5.8%.
5.8% for a company valued like a tech giant.
Precisely. That margin drop shows immense competitive pressure. It kind of suggests their core vehicle business might be becoming commoditized, faster than their big AI vision is actually materializing.
That margin erosion seems to be the key pain point that sources are focusing on. Our material gets into specific cost drivers. Can you maybe zoom in on those drivers mentioned? Like, what about the tariff impact? How does a one-off cost like that affect the quarter?
Certainly. Look, increased operating expenses, higher average cost per vehicle, those are definitely headwinds. But the analysts specifically flagged the impact of tariffs. That cost the company over $400 million just in Q3.
$400 million from tariffs alone.
Yep. And that cost was split roughly evenly between automotive and the energy segments. So it confirms the pressure is pretty systemic, not just localized to car production itself.
Okay, so if we connect that financial reality back to the valuation puzzle.
Yeah.
The stock's price-to-earnings ratio, the PE, on a trailing 12-month basis, stands at a whopping 231.78. A PE of 231. That's just staggering. For you listening, what does that actually mean you're betting on? What kind of guaranteed future profit does that multiple demand?
Well, it means the market is pretty much entirely disregarding the present 5.8% margin and that declining profitability we just talked about. Think about it. A normal profitable automaker might trade at a PE of what, 10?
Right.
Maybe 15.
Standard stuff.
So a PE of 231 means investors expect profits to multiply like 20-fold or even more, and almost instantaneously over just the next few years. Fueled by radically different products, obviously. The fundamentals just aren't keeping pace with the market's huge expectations. And that's why the analyst fair value remains so far below the current trading price.
Okay, so that $133 premium we identified right at the start, it clearly isn't paying for that 5.8% margin.
Not at all.
It's paying for the next segment, the future outlook, the AI and robotics vision, the bull case.
Exactly.
The company's updated mission is now sustainable abundance, right? Positioning Tesla not just as a car maker, but as an AI and robotics leader. And this is where it gets really interesting, isn't it?
This is the sci-fi part, yeah. The primary bet is on full autonomy, and the goal is audacious, to say the least. They're aiming for robotaxis operating in maybe 8 to 10 metro areas by the end of this year. Pending regulatory sign-off, of course. That's a huge caveat.
8 to 10 cities by year end. That seems incredibly ambitious.
It is, and the expectation is to remove safety drivers in parts of Austin within months. Look, FSD Supervised has now covered 6 billion miles. That gives them an unparalleled data advantage, no question.
6 billion miles.
Even though the actual paid FSD customer base is still relatively small, maybe around 12% of the fleet, so the data is there, the monetization isn't quite matching yet.
And this whole autonomy vision is already evolving into specific products designed purely for that future. They announced the Cybercab, a vehicle built strictly for full autonomy, like no steering wheel, no pedals. Production supposedly slated for Q2 next year.
Right.
Okay, the Cybercab sounds revolutionary, totally. But given the massive regulatory complexity just for FSD to operate safely in the U.S., do the analysts see that Q2 next year timeline for a completely new pedalless vehicle as, like, remotely achievable?
The consensus from our sources is, let's say, extreme skepticism regarding that Q2 timeline, especially considering the regulatory lag we always see.
Right, that seems more realistic.
But the strategic value, you can't deny it. It proves the company is thinking way beyond just selling personal cars. They're focusing on mobility as a service.
Ah.
However, yeah, the timelines definitely add to the risk profile, which we'll get to.
Okay, then there's Optimus, the humanoid robot. Elon Musk's vision is that this could be the biggest product of all time.
That's the quote.
And we should apparently see a production intent prototype of its highly dexterous hand in Q1 next year. I mean, this feels like the ultimate speculative piece in the whole valuation puzzle, an entirely new business vertical.
It is, precisely. Look, if Optimus scales, if the returns could theoretically justify even the current crazy PE multiple, analysts seem to view Optimus not really as a consumer gadget, but more as an industrial replacement for labor.
Yeah, okay.
But the challenge is just colossal. Creating a humanoid robot that can reliably do human tasks at scale that requires manufacturing maturity, AI breakthroughs, supply chain development, stuff that simply doesn't exist yet at that level.
Right. You can't just order robot parts off the shelf.
Exactly. So the valuation requires you to believe this revolution happens soon and that Tesla owns it lock, stock, and barrel.
And underpinning all this, they need proprietary tech. They're developing their own AI5 chip. The sources suggest this chip is projected to be, get this, 40 times better than its predecessor, AI4.
40 times, yeah.
That sounds immense. Is this advantage mainly about cutting manufacturing costs, or is it fundamentally changing what the car or maybe the robot can do? How does 40x actually translate into dollars and cents?
It's primarily about the dollars, actually. 40 times better performance per watt and per dollar for AI inference. That allows them to manage the massive data load needed for full autonomy cheaper and much more efficiently than competitors who rely on, say, off-the-shelf hardware from NVIDIA or others.
Oh, okay. So it's an efficiency play.
It translates directly into a cost advantage that, if they pull it off, could widen their technological moat significantly over time. It's a big potential edge.
Right.
And we should probably briefly touch on the energy segment expansion, too. It's part of that sustainable abundance mission.
Right. Megapack and solar.
Yeah. New products like the Megapack 4 are helping improve grid efficiency. And they're starting new residential solar panel production in Q1 next year at the Buffalo factory. It shows continued commitment beyond just vehicles.
Okay, so the vision is definitely expansive. Chips, robots, energy storage, the works. But holding all that potential together requires a strong competitive wall, a moat.
Right.
What do our sources say about Tesla standing there? They characterize the economic moat as...
narrow.
Yeah, narrow. And that assessment really reflects the ongoing conflict we've been detailing this whole time. Look, they have undeniable technological advantages. The supercharger network is still pretty unique. They have that massive AI data advantage from billions of FSD miles, deep vertical integration with chips and software. Those are real strengths.
But these formidable strengths are currently being, neutralized, frankly, by the severe margin erosion we discussed earlier in their core automotive business. Those advantages aren't consistently translating into sustained superior profitability right now. And that makes the moat feel a bit shallow, maybe vulnerable to aggressive, lower-cost EV competitors coming online.
So that margin erosion, combined with all this incredible ambition, introduces massive execution risk, especially for things like Optimus and the Cybercab.
Huge risk.
I mean, bringing a humanoid robot to market involves scaling production for a supply chain that doesn't even exist yet. What's the financial cost of all this ambition? Is it going to drain that cash hoard?
Well, the cost is expected to be huge. The reports say capital expenditure, CapEx, is projected to increase substantially in 2026.
Substantially.
Yeah. To fund these ambitious AI initiatives, the robot, the new production ramps, it means the company's gearing up for a major spending cycle, and that requires absolutely flawless execution across manufacturing, software, and regulatory compliance. Any slip-up gets very expensive.
And speaking of compliance, huge regulatory hurdles remain, right? They still need FSD approval in key international markets like China, EMEA, to really monetize that global data advantage.
This big one, yes.
But beyond the technical and regulatory stuff, we kind of need to address the governance concerns that came up. Why does Elon Musk feel he needs, what was it, mid-20s voting control? For you listening, what's the connection between his equity stake and the actual feasibility of building this robot army, as he calls it?
Right. This is crucial for the bear case, according to the sources. Musk publicly expressed concerns about needing sufficient voting control, aiming for that mid-20s% range, specifically to maintain strong influence over the future vision, particularly the Optimus and robotaxi concepts, the robot army.
Okay.
The material suggests that without that level of personal control, there's a perceived risk that other shareholders, maybe those more focused on near-term vehicle profits and margins, might actually block the massive long-term capital investments required for this AI and robotics transition. He wants to ensure the company stays locked on that vision.
Interesting dynamic. So let's try to synthesize this. Here's the ultimate tension for you, the listener. You've got record revenue and immense cash flow, which sounds great.
On paper, yes.
But it's colliding head-on with sinking gap profits in the core business. And this valuation, this stock price, seems to price in the guaranteed massive success of projects, Optimus, Cybercab, global robotaxi fleets that are, let's be honest, years away from proving any kind of commercial viability. It really is a tale of two completely different companies wrapped in one stock ticker.
It absolutely is, and this raises that really important question. With margins declining in the actual business they run today, is the current high stock price a fundamentally sound investment backed by near-term catalysts? Or is it really a highly speculative bet on sustainable abundance and the immediate successful arrival of that global robot army? The data we've reviewed indicates that the current valuation heavily discounts the guaranteed success of these highly ambitious future projects. It underlines the very speculative nature of that $133 premium.
So, given that wide gap between the current stock price and the calculated fair value from these reports, here's maybe a final provocative thought for you to chew on. How much of Tesla's valuation today is actually based on established, scalable manufacturing efficiency, something they have arguably perfected in many ways?
Yeah.
And how much is based purely on the future potential of this global distributed AI computing fleet, powered by, maybe 100 million cars acting as living creatures on the road, as Musk sometimes puts it?
Yeah.
That question, and the answer investors are currently giving it through the stock price, that's what's driving this entire market debate. Well, thank you for tuning into this deep dive into the source material on Tesla. We hope breaking it down this way was helpful. If you did find this synthesis useful, please do hit the subscribe button and the bell icon. It really helps support this channel and ensures you don't miss our next analysis. Thanks for your engagement.